Hello, everyone, and welcome to Money Tip. This is Jim Ludwig, the founder of Main Street Financial Planning. And today we're going to be talking about the American Rescue Plan Act and why adjusted gross income is so important. By the way, this is not personal tax advice. Make sure you check with your tax preparer, whether it's a person or online, because this is very complicated, but AGI is going to be a big factor. So let's talk first about the stimulus. Many of you already have received your money, or you're going to get it in a debit card pretty soon. It's got some pretty strict phase out versus the last stimulus packages that we got when we got $600. The phase out is going to be 150,000 to 160,000. That's about a $10,000 window where it phases out, and phases out pretty quickly, and that reduces the amount of money that you and your family members, if you have them, are entitled to. AGI at the end of this tax year is control whether they take some money back from you, or in some cases, they actually give you more money. So let's talk about an example of a single parent with two dependents. They're going to get a nice $4,200 check as long as their AGI is under 75,000. If it's 76,000, and you can see this on our slide, a $1,000 increase in AGI is a loss of $840 that they'll probably take back from you on your tax return. So make sure that AGI is at the appropriate level, whether it's 75 or 150,000. Let's talk about the child tax credit. It has two phase outs. The first one you can see here is the same $150,000 for a family and $75,000 if you're filing single. For every $1,000 of adjusted gross income over the limit, they're going to take away $50 of that tax credit. Now, this year, it's sort of split into two areas. One where people have income larger than the normal phase one limits, and they're eligible for that $2,000 per child. But the Stimulus Act made it $3,000 for children between 17 and 6. And if you have children under 6, the tax credit is $3,600. Don't forget that $1 over your AGI will cost you money. So if you were $1,001 over the limit, that would be a $100 reduction of your taxes. The checks that they're going to start sending you should come in July, although I'm not absolutely certain of that, but that's what I've been told and read. And then lastly, in our money tip today, let's talk about dependent child care credit. This is different than the tax credit. And they have greatly increased the amount of money that you can calculate your tax credit. So it's gone from $4,000 to $8,000. And instead of having 35% that phased down to 20% if you met the income limits last year, this year it's $8,000 per child, and you get a 50% calculated tax credit, which is $4,000. That's the maximum. And if you have two or more children, you can use $16,000 of expenses times 50%. So the maximum that you can get as a tax credit for childcare would be $8,000. So make sure that you know your AGI, whether it's in phase out 1 or phase out 2, because this is going to be important. And by the way, that dependent child care tax credit, you get that on your tax return. So some people that are at lower income levels that might have a $500 payment due might find that if they had two children, it would be $8,000 minus the $500 they owed the government. They would get a check back from the government for $7,500. This is a huge stimulus package this year, and some people will get it early next year when they file their tax return and get the child care tax credit. Anyway, today's money tip is pay attention to your adjusted gross income, read up on all the benefits that you're eligible for, and make sure your children or grandchildren, if you have them, understand the rules too. Thank you, everybody. Have a great day.